Hello, welcome to Money, Stocks and Economics. Today we're gonna look to another company to invest. This video will be short today. I'm a little bit in a rush, but the company we'll be looking at is Double Down Interactive. This is a Korean company that has situated in United States and is from Korea and is about digital slot machine betting company. As we can see here, they do games like slot machines, digital mobile games for cell phone, and people play it and invest their money. Sometimes they win, sometimes they lose. Of course, they lose more than they win. And this company is very profitable and is trading very cheap. So is probably I shouldn't say it is a good investment. It's from Korea, as I'm showing you. Uh, it's like a very big company in Korea. A great number of employees, is well managed, and is operating in almost everywhere in America. This is a lot of games, so you can put money, bet. If you win, you can withdraw. If you lose, the company takes a great part of the profits. So let's see here. What matters in the is the financial statements. As we can see here, the cost of the revenue is very low, right? In relation is about 1/3 of the revenue is profits. So this is very good. Almost 1/3 is profits, as we can see here. Uh, and the stock is very cheap. As we can see here, the amount of free cash flow they did in the last years is being reducing. This is because of the events of 2020. People got locked in houses, so they tend to bet more as they got bored, and the cash flows is stabilizing now. So it's not much of a problem because with this cash flow, the company should be with this level of cash flow, the company should be worth triple the value of the stock today. So it gives us a great margin of safety in this investment. As we can see here, no debt, almost no debt in relation to the total assets. The assets that they have is not necessarily, you have to subtract the goodwill assets because they are from acquisitions of other other companies. Like the goodwill in a balance sheet is almost like a block of clay, as you can mold it to fit the balance sheet. In accounting, the asset sides and the liability side plus the equity has to do the same value. But when you buy someone else's property, sometimes you don't have a way to balance it out the balance sheet. So you create goodwill, and goodwill will be any value as you can put there so you can make the balance sheet balance. So you have to discount like this three, the four, the 800 in total assets. You have to discount the value of the goodwill so you can make a good analysis. So this is 400 because the goodwill is almost 400, as we can see here, right? The intangibles of the intangible assets are 51 million. The goodwill is the acquisitions. As we can see here, the goodwill shortened it in half because they don't need that amount of goodwill to balance the balance sheet. So it's got smaller and it is going to be smaller every year until they got to zero. because they are expensing in the income statement this acquisition or the investment in research and development. So you have to take this information with a grain of salt. So this is half, but either way, being half or not, they have a very large cushion of protection against the bad investments. As we can see here, the working capital is 250, and the shares is 2 million shares. So if you divide the just the working capital for the share outstanding, we can see the stock should trade to 123, right? Simple math. It's worth 400, right? In assets. If you have a baker and you have in cash 400, and you divide that cash in the end of the company to two people, each people should have 125, right? Or 200 in this example. So if you take the total assets of this company and reduce it by the 2 million shares, the 400 million they have in assets, reducing the goodwill, and it will reduce for the number of shareholders, each shareholder must have a stock not corrected by risk of 123 and a half. So if we take this amount of working cash flow, reduce the total debt, so zero debt, reduce reduce the necessity of capital expenditure. As we can see here, is very low. Their capital expenditure is 200,000. So let's reduce 1 million just for the sake of it. And if you correct by risk of the shares and the business to go bankrupt, is, let's say, 20%, right? So we reduce this of 20% reduction, like 142. Then you divided this for 2%, for the 2 million stocks, and each stock should trade of 21 and a quarter of dollar, and is trading now 14.75. So you have some moral problems with this company, because it's very addictive products. Like cigarettes is a product that people get to get addicted to and spend their money. It's not a moral company or immoral company. It's just a investment, but they have this I don't want to say good thing, but it's an addictive product. Some people are susceptible to be addicted in betting, in losing money and winning money. So their, let's say, customer base is very loyal, and the companies should maintain their their base customers. As I said, the amount of cash flow they are doing, combining, let's see, just the cash flow they did for last year, divided divided by the number of stocks, you're gonna do half of the value, like 10. If you in is the worst revenue, let's see, for this quarter, the quarter of this year is already made 68%, 68 million. So let's suppose they will do half of it in the next, so 34 again, right? So they will do 102 free cash flow, divided by the number of shares, 2 million. Each share should be valued as 51, and now it's trading to 14 and 70. So low debt, great returns. the investment, the return on investment is really great. Like, let's see, 102 divided by the liability side and the number of shares times the value. So the number of shares is 2 million, the value is 14.75, so it's 29 plus the 75 million in debt, dividing in the denominator 74 divided by 102, 104. So we can see here is 98%, which is crazy, return on investment. So the money that is invested in the company is returning, is doubling each year. Of course, this is a mistake because they developed the software. As you developed the software, you cannot hold the value of the cost of your development, all of it in intangible assets. So this value this value which represents the investment of the company is very great because they invest a lot of money over the years to create their program. So it's not 400, it's almost like 400 for the asset side, reducing the value, right, in goodwill. And plus, in this time, in this question, to calculate return on invested capital, you have to add the goodwill because they invested buying their software. So is the return for this year projected divided by the amount of assets. So the return on invested capital is 12%. Is 12%. Is the double of the interest rates in America today. So it's not an outstanding return, but it's a good return. And the fact that is so different from the other calculation is because they have a lot of internal created assets that don't show in the balance sheet. So you have to use the total assets and reduce it for the return of invested capital. The normal formula is the NOPAT, that net operating profit after taxes, so 33 minus 132, it will be 99 divided by 100 is almost the same, 12 and a third. So not outstanding return on invested capital for any metrics that if you corrected for the outcome. So it's a very good investment, making a lot of money, no debt, stable cash flow, addictive product, and as we can see from the diversion in the cost of the revenue and the total revenue, we have a very good margin. So here is representative the marketing power of the company, because they can charge a premium that other companies maybe cannot. So that's why this difference is so great. That's why they made a third of the total revenues as profits. And that's it. No more to say. Low debt, low risk, two little stocks to divide the number of cash flow it's been doing. Yes, the company is a great investment. Just to have to hold it and wait. So this is the short analysis for today. Thank you very much. Subscribe, and let's see if we can make some money together. Out.